morning. We're Precedent Wealth Partners. Let's talk. My name is Drew Casey, joined here today by Grant Williams, CFP. We've got an exciting topic, Grant, this morning. Today we're talking about something called Buffered Equity ETFs. ETF, of course, means exchange-traded fund. So this is a very specific type of exchange-traded fund that we're going to talk about today that has some unique characteristics that has been kind of somewhat democratized in recent years, and we'll talk about the history of something like this in a little bit. One point on compliance here before we get started. This is a bit more specific today than some of our topics typically. Hopefully we're educating you on a particular variety of investments you can make through exchange-traded funds. And these are, as I said, something called buffered securities. For that reason, it's important that we call special attention to the disclosure side that you'll see at the end of today's video. These buffered securities, they have certain appeal in specific situations that we're going to talk about for investors. That does not mean that they are free from risk. And so we'll talk about some of these characteristics, but always important to point out that these investments are not free from risk. Our disclosure slide at the end is included so that you can educate yourself more fully if you choose. Obviously, we invite you to reach out to any of us on the team if you have further questions about this particular slice of investment vehicle. With that said, we can go ahead and jump in. Grant, we'll just get right started. Can you tell me, what is a buffered equity?
Yeah, absolutely. Well, we did kind of a little bit of a video before this on buffered ETFs, and so call this part deux, if you want to speak in French.
Sure,
if you will.
I'll leave that to you.
Yeah. Well, I've shown you the extent of my French, unfortunately. So
sounded pretty good.
But yeah, these buffered equity ETFs are interesting, and look, they're not a fit for any situation. Really, you have to get down to your individual circumstances and needs, your goals and objectives to really determine if these are something that you might want to use. With that said, we do think there are a lot of applications for them, and so we're going to kind of walk through that today. What are these different slices of buffered equity ETFs that can be used in different situations? So really the overview in history, if you will, is these securities have been around for a long time. Big family offices, ultra high net worth individuals and families would use buffered ETFs as kind of a collar around their stock exposure. They just wanted more predictable returns. And in doing that, there's no free lunch. You sacrifice some upside, but you basically buy some downside protection. And you do that. Go ahead.
You use the word collar. Could you elaborate on that, or maybe that's what you're about to get to?
Yeah. No. In the past, these families, they might have teams of traders and analysts who would create that collar using options. They would go out into the regulated options market and buy derivatives on a broadly accepted index, kind of like the S&P 500, for example, if you were taking it to modern day. And they'd buy a put and a call out far enough to a certain date and create that defined outcome basically using those options. And so options can be kind of speculative in nature in that you can go buy an option on anything and say, I think XYZ stock is going to be higher or lower at a certain future date. And that's pretty risky and pretty speculative, but when you're kind of creating a defined strategy by buying an offsetting put and call, it can create a really defined outcome. Options can also be used if someone has a concentrated position, they want to hedge their risk and kind of de-risk themselves. They can do some things there to do that. So they really do have a nice purpose, and really that's what's going on in these securities is that collar that you mentioned is being created with underlying options
inside these
ETFs.
Fund.
And so now you're getting to kind of modern day when you talk about it. So these ETFs can now be purchased really by anyone out there, us, any sort of investor. They're very much democratized. That's the word you used earlier. They can be purchased in a brokerage account at virtually any custodian. They have daily liquidity, just like any other ETF and stock. You can buy it now and sell it tomorrow. There's no lockup period or anything like that. It's not an insurance contract, nothing like that. So very liquid, very accessible, and we've just seen the use cases and people using them increase greatly in the last couple of years.
You mentioned a kind of defined outcome. I think those were the words you used. What exactly does that mean? What are you talking about when you use that kind of language?
Yeah.
on an exchange traded fund.
Yeah,
for example. How
absolutely.
does that work?
Let's just dive into kind of the illustrations,
Yeah.
if that sounds okay to you. We have a few examples for this video that I think these are just meant to be illustrative, just to give folks an idea. And to make it easy, we're just going to look at kind of a period of 1 year. So when I say 1 year, call that like the target outcome period.
Okay.
You could hold it for 10 days or 200 days or even longer than a year. If you get to the end of the year and you want to keep holding it, it just resets internally and you keep holding it. So
Because you're holding the fund, the options are all handled by the fund manager. That's all happening internally. You don't have to worry about
inside the ETF.
the coordination of that.
Absolutely. So, no, you said it, Drew. And so on this first chart, just imagine that from left to right here, you're looking at a period of 1 year. So, you can kind of see day one there over next to the 0%. You can see day 365 over on the far right.
Yeah.
And the orange illustrates your downside protection. The blue illustrates your upside participation. And so, if you were purchasing this on, say, the S&P 500, what this chart basically tells you is if you got to day 365 and the S&P was up 11.5%, you would be up 11.5%.
Full participation.
Absolutely.
Okay.
To take that a little further in each direction, let's say the S&P 500 on day 365 was up 20%. You would be up 11.5%. So you give up that upside, right?
Yeah.
On the flip side, it's still in the blue, if the S&P was up 5%, you'd be up 5. So you're participating in everything up to that cap of 11.5.
It's kind of the zone of opportunity there in blue.
That's well said.
Yes.
Yeah, I'm going to remember that term. Trademark
I think we used that back in the day playing Call of Duty, maybe.
Wow. Whoa, what a reference. Okay.
Anyways.
That'll only appeal to a certain portion of our audience.
4 or 5 of them.
That's right. The bottom portion in the orange is where the downside participation starts to come in. Let's say the S&P was down 15% on day 365. You would be even in this case. And we're creating some exact results here. It could obviously be anywhere in between. We're just kind of trying to illustrate it. Mm-hmm. But if the S&P was down 15% after 365 days, you would be flat.
You're shielded from all of that.
You'd be shielded from all that loss. Exactly. Let's kind of let's extrapolate that again. If the S&P was down 5, you would be flat as well because you're still in that orange buffer zone. If the S&P was down 25, say it had a really bad year and it was down 25% after 365 days, you'd be down 10 in that example. So you're shielded from the first 15, great word that you used, but you're going to start picking up the losses after that buffer.
Okay, that makes sense.
So yeah, that's how it works.
Yeah.
And we're going to get into sort of some applications and why, kind of the why to these in a second. But does that sort of just set the table on that example?
I think, that makes sense. That's well explained. Thank you.
And I'll just give another illustrative one right here. I won't go as in depth on this one because we just kind of went into the weeds on that last slide. But this is an illustration of how you can slice it kind of any sort of ways. There's enough ETF managers and providers out there today that are really, there's a host of options. You can have you got more upside and less downside. You can have way more downside protection and less upside participation. And so this is one of those examples right here. It's the exact same thing, but you can see that upside cap is much less. It's 7%. But you have a huge portion of downside protection. So
50%. Wow.
We'll get to this here in a second, but we've seen a lot of investors who have kind of short or intermediate term cash say, hey, I need this money in 5 years for a down payment on a house. I don't want to subject it to complete stock market risk.
Of course.
But something like this is sort of interesting. It can beat a cash return. Obviously, you can be flat after a year, so it can not beat a cash return as well. But a lot of people like the chance to go get 7, and you're insulated from 50. So it can be a pretty interesting option.
50% is a significant downside protection.
Absolutely.
If the market was down 50%, it's probably time to forget about your down payment and buy the market.
That's good.
Not an official recommendation, but
right.
No, I think that's a good illustration because that shows the trade-off there where you lose some upside cap in exchange for that additional downside protection.
Yeah.
So there's a balance there between those two things.
Absolutely. I think I was just going to jump into summary real quick. I think it's really important to note that for most people, especially if you're looking at someone like our age, even for retirees in a long-term allocation, you wouldn't want to, in most cases, unless you just wanted the conservative downside. And obviously it depends on your individual preferences and risk tolerance and objectives and all those kinds of things. Of course, it depends on those things. But, for most people, you wouldn't want to give up the upside participation of stocks. And, we operate as a fiduciary here. So, we want to give clients advice that's in their best interest. And outside of these use cases that we're talking about, it's probably in your best interest to be in stocks for your aggressive portion of your investment allocation. And so I think that's an important note, but I'll let you lead the way here and I can take us through them. But, we think they have some use cases. That's the term I really like to throw out.
Yeah.
So,
well, I think one of the ones that, like you said, we've been seeing more recently, and you highlighted there in that second example, is maybe kind of an emergency fund replacement. Do you want to talk through the options there and the potential benefits to doing that?
Absolutely. Absolutely. Yeah. And we touched on kind of like down payment money, right? We see that with a lot of clients, like, I need this in 3 years.
Short-term goal.
Right. So that's good. We kind of already hit on that a little bit, and encourage you to reach out to us if you have questions about something like that. But yeah, emergency fund replacement is one we've really seen kind of take hold, and some of our clients have been interested in. And we'll kind of take you through why. Before we kind of dive into that, what's sort of the blocking and tackling kind of vanilla ice cream option for an emergency fund, right? It's
high yield savings, CD maybe.
Yeah,
some institution.
Even a lot of our clients maybe haven't fully thought that through, and they've just got it sitting in a savings account at the bank, and it's paying them 0.1% per year, something insulting. So, this is important, and it's been an interesting strategy. We've encouraged some of our clients. Now, you might keep some of it in savings or in a high yield savings, right? But maybe once you get there, if you need cash for any reason, consider this as kind of an emergency fund replacement. And really, when we highlight that, we're talking about that big downside protection version. So that second one we went through that might have a downside protection buffer of 40, 50, 60 something percent, and a smaller cap. So when you think about it that way, and taking this a step further, if you hold these securities in a brokerage account, you gain some meaningful tax leverage. And let's explain to you why. Let's say you hold it for a year and it's up 7% and you've gotten the full participation in the upside cap.
That's great.
There's nothing stopping you from just letting it reset internally and continuing to hold it. And that means you reestablish control over realization. You haven't sold it, and so therefore there's no tax drag like there would be inside of a high yield savings account.
That account has interest that's hitting your tax return as ordinary income.
If you're a high income couple and you have, let's say you make $700,000 or $800,000 a year, every incremental dollar of income is at a bit. You're paying what 37% tax on all that interest. And so really, what seems like in this current environment, 3.5%, 4%.
Sounds pretty good.
It's not, but it's under 3% when you tax on an after tax basis. And so, if you can put this money in a buffer and have the chance to get something like 5, 6, 7, but more importantly, not realize any tax, it goes past a year, and then if you ever need it, you're selling it at long-term capital gains rates. So, that's between 15 and 23.8%.
Yeah.
So there's some meaningful tax leverage gain there in that example. And you
especially for something that doesn't have a time horizon like 3 to 5 years. That
exactly.
Maybe you can hold it 10 or 20 years.
Exactly.
That's a lot of taxable income that you're avoiding.
We have a little example of this, just a little kind of simple Excel sheet. I've been talking way too much, as I always do. We'll let you walk through this if you want, just kind of an illustration.
No, I think what we've got here is really, we call this a comparison of two emergency funds. You can see number 1 and number 2 there in those columns.
And I'll just add, this is totally hypothetical. Like we're trying to make this illustrative. Obviously, it depends on the circumstances in the market and how things are looking. This could change rapidly.
Absolutely. And we'll walk through some of the assumptions we made that are just those assumptions. But this assumes kind of a starting balance of $50,000. And we're running this for 5 years just to kind of show the tax leverage that we were talking about earlier. Emergency fund number 1 there, you can assume that that's a 3% interest rate reinvested, and then you're paying 30% federal tax on that, just kind of an effective number. And you can see that grows nicely, between year 1 and year 5. 51,000 is kind of at the end of year 1. You can see by the end of year 5, you're at 55,500 more or less.
Yeah.
Which is nice. That's great. We've got cash. It's highly liquid, available there in the high yield savings account. We look at emergency fund number 2, however. This kind of assumes a buffered investment.
Yeah.
Something where you can participate in market upside, and there you can see that we've assumed 5.5%. Per year. Obviously, that fluctuates year by year depending on how the market performs. But if we just assume kind of that average, long-term capital gains rate of 18.8% at the end. So we're assuming this sells in year 5. So this is growing like any other investment vehicle for 5 years with no transactions. And then you sell it at the end of year 5. You can see, at the end of the year 5, you've got 65,000 and change there. You only owe about 3,000 in tax there on that transaction, assuming you liquidated all of it and paid 18.8% on the gain. And so you kind of have an after-tax number of $62,462. So you can see that's a meaningful, over 5 years, that's a $7,000 swing on a $50,000 emergency fund, which it's a trip to Disney World or maybe half of one.
Nice.
You would know. I don't know these things, but that's meaningful money. That's not chump change. So,
what's your favorite ride at Disney World? Just to get off topic for a second.
Never been to Disney World. Been to Disneyland, California.
Okay,
but I haven't taken the kids yet. They're too young.
Okay,
so that's in our future.
Our production team is going to be, I don't know, maybe a little upset with us for getting into this.
Could be sort of a dead end. Yeah.
Okay. Well, just for the record, my favorite ride is the Toy Story ride.
Okay.
At either Disney World or Disneyland. It's the one where what?
Yeah, that's what I was going to ask. Well, what's the theme?
Well, you're in the cart, and you put on those glasses, and you kind of have this little toggle, and you like pull it, and you have a passenger, and you pull it.
I can see it perfectly in my mind.
Yeah, and you pull it, and it shoots these little rings. It's like virtual reality rings, kind of.
Okay.
Rings, darts, Sheriff Woody's stars, whatever, onto these targets, and you get points, and then you compare your points against those in your party. It's a good ride. It
doesn't really seem like it's that Toy Story themed, other than maybe
it's Toy Story.
The visual elements. Okay.
There's Buzz, there's Woody,
okay.
There's Slinky Dog, there's all the folks.
Okay.
You're at Andy's house.
All right.
It's good to go.
Okay.
Back to buffered equities.
Yeah.
I interrupted you.
No, that's fine.
Yeah. Okay.
Yeah.
Nice.
Hopefully that illustration was helpful.
Yeah.
You can see the difference here in dollars just by making different selection in your investment vehicle.
Well said.
Yeah.
Perfect. Well, I think we're kind of wrapped up here. And
I think so.
More than just buffered equities, we've covered a lot of items that are important in today's world.
Yes.
Toy Story 5 coming out recently, so I guess our stuff is timely here.
It is.
Yeah, thank you so much for joining us. And remember, we just want to, give you a reminder and take the time to, in this case, if you're watching this and you've watched it all the way through, pay special attention to the disclosure side, at the end of the video. It's provided for you to look at and encourage you to take the time to actually read it. As you may have concluded from listening, these buffer securities can indeed be appealing in the right circumstances. And, look, they provide a partial measure of protection or downside risk. But to reiterate what we said at the beginning, that does not mean they're completely free from risk. The protection they offer comes with a cost, particularly in terms of limitation on one's upside return potential. So, excuse me, that can be something to keep in mind. Our disclosure slide will, again, follow at the end of this video, so please take the time to review it, and you can fully educate yourself on all of that. And obviously, it goes without saying, but we encourage you to reach out to us if you have any questions at all, or if you want to take a deeper discussion, take the discussion a little deeper, I should say, on the risk factors for making any decision related to buffered equities that you might like to have included in this kind of investment strategy. So,
does that offer apply to only the buffers, or can we talk about Toy Story, Disneyland rides?
The offer absolutely applies to Disneyland rides, but if they want to talk about Disney World, they're obviously going to have to call me because you've only been to kind of the cush environment of Disneyland.
75 degrees.
And you do not know.
Clear and sunny.
You do not know true pain and $12 water bottles like I do.
Yes.
But nonetheless, a good time.
Fair enough.
Yeah. All right. Let's wrap up before we get ourselves in trouble with the production team. I'll go ahead and do that. Thank you for joining Drew and I here for this series on buffers. And just excited to talk through it with you. Until we see you kind of on our next topic, we're Precedent Wealth Partners, and have a great day.